your favorite fund manager? Somebody who tries to do value style investing, or somebody who goes for high growth, or somebody who's hell bent on quality of the stocks, right? This is a perennial debate that happens in the investing world. We have top investment gurus who have carved themselves a style of investing, right? Value investors are very successful investors, but then in mutual funds, there are also fund managers who manage growth style portfolios and have delivered very high returns. And of course, there are people who are very particular about the quality of the stocks that they hold, so that those stocks hold them in good stead even in downturns. So the question first of all is, when should you be holding value, growth, quality? To answer this question, you should actually know the cycles of value, growth, and quality. And that's what we're going to discuss today. So let's first look at the very conventional definitions of value, growth, and quality. Value investors, typically try to find stocks that are below their intrinsic value, below their real worth, right? For example, if a banking stock is, trading at less than price to book of 1, it is considered below its intrinsic value. Right. There have been instances when several banks in, say, 2013, when they hit rock bottom, or in 2016, or even after the March 2020 corrections, moved to price to book of below 1. Or value could be when, the price is not really capturing even as the earnings is picking up. So these typically, conventionally, are considered value. When you look at growth, obviously, fund managers scout for stocks that typically have an earnings run rate which is far higher than the market or the index. And they are not too worried about the price at which they enter, provided, the growth momentum is expected to continue, or they forecast that it will continue. How about quality? Now, it's not like, in both value and growth, you are oblivious to quality. Obviously, you don't want to hold bad stocks. But quality is something more than just holding good companies or good management companies. Quality is about these companies having a high moat to withstand any kind of difficulty in the industry or the economy. For example, having a very cash-rich balance sheet can help companies, tide over very high interest rate scenarios, or when borrowing is difficult, etc. Or when even growth is bad, these companies with their rich cash reserves can give you back dividends. Classic examples are consumer companies. Even when they're not growing very high, they ensure that they pay you back in terms of dividends. IT companies do that too, right? So these are typically companies with very rich balance sheet that can withstand even downturns, like what is happening in the IT right now is a classic case. Still, they are considered quality companies. Now, these are the standard conventional definitions of value, quality, and growth. Now, I'm going to move on to, explaining these three through something that you and I will kind of probably relate to well. Let's take the case of, somebody running a marathon, right? You relate a good marathon runner, or you can even call it a sprint, it doesn't matter, to a growth company. A growth company which is clocking high returns is equivalent to somebody who's running at very good pace, right? Now, you see a company that has already run up with a very high pace, and then you want to enter the company, right? This is like, so this is the first, image here that the company is running well. But the company does have its burnout too, or it could be confronted with various macro issues or internal issues, which we will talk about later, right? And it goes into a phase, it probably is going into a phase where it's slowing down, and you're not aware of it, and you try to enter it, right? That is when typically growth starts slowing, and you entered at a high valuation thinking that X percentage of growth will happen, and it doesn't happen, right? And this company, can do two things, right? It can completely go under the radar because it has a leveraged balance sheet. It grew with high leveraged balance sheet. It's not able to pay back, and then there is a burnout, right? If this person who's running the marathon or sprint tries to push himself or herself more, there's a burnout, and that's typically what happens if the balance sheet of the company is not strong, the company struggles. So now look at this. We started with growth. Now I'm talking of balance sheet, which means quality starts mattering. So when you are entering a high growth company, quality starts mattering a lot, simply because if you think, this company may not be able to sustain this kind of growth rate for long, even if you don't think, it will happen at some point, right? Unless you have entered a company with very high quality balance sheet that can stay, help the company stay when the slowdown happens. For example, I'll just give you a simple example of microfinance institutions. In microfinance institutions, when there is a downturn like COVID, they get severely hit. Obviously, nobody is going to repay. They're going to have very high NPAs. Are they able to withstand all this pressure with a strong balance sheet, right? Or are they able to kind of recover from it by infusing fresh capital, right? Some of the microfinance institutions did just that. They infused fresh capital and made sure that they were ready. Even while they were ailing, they made sure the balance sheet was strong to take this hit and that they were ready for the next leg of growth. Now, this is what typically happens. And at this point is when you can actually get value or value trap. The slowdown and the recovery phase that is happening, can either go bad or there can be a strong recovery. Just as this, sprinter or this marathoner is, stretching and exercising and recovering, that same recovery can happen in balance sheets. Once again, you can take companies such as metals, mining, cement. Some of them really went bad. They were hit bad because their balance sheets were not in good shape and they went down. Others recapitalized. They took the time to improve capex. Even as a slowdown was happening, they took the time to improve their capacities to be ready for the next capex. They did consolidation. They acquired companies. They had a sound balance sheet. They could acquire companies. They consolidated. It happened in cement, it happened in steel, it happened in many of the commodity space. And in the case of finance too, recapitalization helped build a sound balance sheet. All the NPAs were written off. The cleaning up was happening, and so on. I mean, this happened, almost between 2012 and 22, across the economy in various forms. So this phase is when you actually identify companies that can come across as value or value traps, right? Those that you recognized value, please remember, may not necessarily be cheap. For the simple reason, there's no earnings. So when you look at price earnings of these companies, they might actually be elevated. But possibly when you look at price to book, the book, may even be below the price, right? So this is a typical thing where sometimes you can miss the stocks thinking they're very high on PE, but what's happening inside may be different. They are building their quality and ready for a takeoff. So growth, slow down. Quality helps, sustain or rejuvenate. And then there is a temporary value, and then growth starts again. In this cycle, anything can happen. Companies can fall out of the radar, or they can once again come back. And when they come back, sometimes they may be slower, or sometimes they may be faster, right? So these three, metrics that you're looking at for style of investing is essentially a part of life cycle of the market in my view. So I'm just getting into, things where how can growth go wrong, right? When growth is unsustainable because it's highly leveraged, growth can go wrong. Or inflation, inflation can really kill growth, they say. Why do we say that inflation can kill growth? Simply because during inflation, what exactly happens is that interest rates over a point go up. And growth stocks are always evaluated based on the discount rate, right? The DCF model. You look at the present value of all the future cash flows. And in a high interest scenario, your discount rate is always higher. That means it starts hurting the ultimate price that you forecast for a stock. So in high interest scenarios, in 9 out of 10 times, you end up with a price that may seem quite bad, and it may not even be attractive to enter such stocks, right? So that's when That happened post 2020, 21, 22. Now, when rates remained elevated, you saw that the market shifted from growth to value, right? The market sees less downside in value because they are already in depressed stage, and if they show potential for future earnings growth, clearly the market will pick them, as opposed to these growth stocks which, on a discounted basis, don't show that potential, right? So this is what happens typically for a growth to move out of that growth phase, right? Naturally, there may other external things happening in the economy. The industry may be undergoing a slowdown. There may be not much pickup in demand, or other things like high input costs, etc., may start hurting. Again, these things happen during high inflation scenario more often, right? So what happens in that case? When such things happen, cyclical businesses suffer because of high input costs, consumer companies suffer because there's less demand, because there's less money in the hands of people, and so on. Uh, just because a stock is cheap does not mean that it will have value, right? That's where I go back to the value versus the value trap that I showed you in, the marathon. So growth slows. The question, is whether this company can continue to hold on to its pricing power, whether it has the balance sheet strength to manage its cash flows and so on, right? That's where quality comes in. And that's why I'm saying, even in a high inflation scenario, the switch from growth to value is not really automatic. You have to focus on quality, because only if you focus on quality, whether this company can, tide over this difficult phase and come or not. And in other words, if you enter a stock at a late stage of its growth, in the sense the stock has delivered, what is a late stage of growth? Stock has run up a lot based on earnings growth. Earnings growth has been very high, but then on a quarter to quarter basis, you see a slight, slowdown in the pace of growth. Those are signs for you to know that growth may be slow. When you enter such stocks, you have to focus on the balance sheet. What will happen if this company is not able to grow? Does it have a strong balance sheet? Or how about its business? Does it have a high moat in terms of good, pricing power and so on? And that's what fund managers also try to do more often than not, um, because they have to stay invested at all times. Even when growth is slowing, they have to focus on deploying their money, right? So that's when we start looking at quality. But, again, it's a cycle, and quality is not always, in vogue right through, unless it is eventually able to deliver. Quality is when I, seek comfort. When do I seek comfort? When things are not okay in the market, right? Like in asset classes, we say, safe haven. Gold is a safe haven. When equity is not doing well, we move to gold. Similarly, you look up to the balance sheet. So when a sprinter is tired, you look at the state of the person. Can this person, recover and go again for another sprint, right? That's exactly what quality assessment is about as far as a company is concerned. So when these companies repair their balance sheet, or recapitalize, or deleverage, they sell some unwanted assets or land or build, and kind of ensure that their debt is lower, or they hive off businesses where they are not very good, and ensure that their balance sheet is stronger or leaner, etc. That is when you start believing that this company may be able to still kind of go back. But because there is no earnings in that company, I mean, there's no much earnings growth in that company will not be favored by the market, and that is the stage or the phase at which it will be valued. It will quietly be repairing itself internally. You may not be aware of it entirely unless you dig deeper. Like I said, microfinance companies getting stronger, or banks getting stronger, or cement companies kind of building capacities, or some of the engineering companies hiving off some of their segments and focusing on the high margin segments. All of these are examples, right? So that is where, but what you prepare all this to ensure that you go to the next leg of growth. If you don't go to the next leg of growth, I won't continuously pay a high price for quality. Quality is when I seek safe haven, so I'm willing to pay a high price to stay there, to stay safe, or to be less hurt. But I won't, perpetually be paying it unless the quality is able to deliver. And between this period when this quality, and quality, you enter at a high price, but the market soon realizes, if things are not okay, if things are okay, the high price will normalize, growth will start, which is fine. But when you enter where there is repair happening, and you don't know whether that repair will be successful or not, is when there is value, right? So this typically, many companies in my view go through this phase of value, growth, quality. So the same company becomes value at some point and growth at other times, right, over a phase of several decades. And therefore, while the conventional definition tries to bucket sectors as quality or growth, I would think that looking at companies individually, and assessing where they are in the overall scenario, in the overall macroeconomic scenario, and in the industry, in the scheme of things, would be the right way to actually assess whether a company is value, growth, or quality. And obviously, at all points, some companies may be value, some may be growth, some may be quality. And in your portfolio, the best thing that you can do is to be able to identify these three if you plan to hold a diversified portfolio, so that at least one kind of delivers, if not for the other. If you like this, do subscribe to our channel, and look out for more such videos.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.